What's up, traders? What's up, tycoons? Super excited for today's video. We're seeing lots of bullish signs across the market. All right, we're going to break down those signals, such as the signal here. All right, there's also signals on many different internal and breadth indicators. All right, when we take a look right here, okay, we're also getting another buy signal or basically a sign that things could be due for a bounce. Okay, wherever you look at it, across many different spectrums, we're seeing these different buy signals appearing right now in the market. Okay, and if we take a look, basically last week, all right, the only thing that finished off positive was actually tech over here. Okay, tech, on the last trading day was really about the only positive thing in the market. We're going to break down, a lot of these signals, all right, these bullish signals, but we've also got to talk about some of the warning signs, right? I mean, 3 out of 4 of our sectors are bearish when it comes to defensive, right? Or rather than bearish, defensive. We're seeing lots of defensiveness in the market. I mean, when we take a look at risk on, risk off, we're seeing that the market, the risk off ETF basically that I have created right here is breaking out, right? And we're seeing risk on continuing to make new lows. We're seeing the market continue to make new lows. When we take a look at the 4 pillars, I mean, things look nasty on the 4 pillars. Okay. Take a look here, right? We have tech and we have semiconductors breaking down from support now. They've been bouncing off of this support for a long time. Meanwhile, we have home builders and industrials already broke through that support and testing their next demand zone. Is this a sign of what's to come for tech and semiconductors, which hold a very large weight in the market? We're going to break down all of this in today's video, so be sure to smash the like button, subscribe to the channel. This is going to be really good, valuable content you're not really going to find anywhere else on YouTube. All right. As always, the content on this channel is just for informational purposes. Okay. It's not meant to be relied upon as legal, financial, investment advice. Just keep that in mind. And we'll go ahead and we're going to start off here with the 4 pillars. Right now, why do I call these the 4 pillars? What are the 4 pillars, you may be asking? Well, what we've got is tech on the upper left right here. We've got XLK, and then we've got SMH right here. All right. And the reason being is because SMH is your semiconductor ETF, and it's arguably one of the most important sectors of the tech sector, right? A subsector of the tech sector. Then over here to the bottom left, we have XLI, which is your industrials. So, for the stock market to really be performing well, you need to see tech and industrials performing well too. Okay, you need to see both of them in that alignment. If there's a divergence between them, all right, oftentimes the market is choppy. And as we see tech breaking down below support and we see industrials breaking down below support, we've seen, it's not a coincidence that we've seen the market be an absolute bloodbath, over the past couple months. Okay, so this is a great way to get a look at, some of the breadth of the market. All right. And as I mentioned, with semiconductors being arguably one of the most important subsectors of tech, home builders are going to be one of the most important subsectors of the industrials, right? And the whole process behind this and thinking of it is, if the market is doing good, we should see tech doing good, right? We know if tech is doing good, most likely the market is doing good. All right. Reason being is because tech is so heavily weighted in the S&P 500. But when it comes down to it, if the economy is doing good and stuff, you want to see industrials doing well too. Okay, you want to see the companies manufacturing and actually making the goods that run our economy. You want to see them performing well too. Okay, and home builders are very, very important for getting a feel on the economy and the sector as a whole. And we can see, as I mentioned, these are all breaking down, right? This is a weekly time frame. If we zoom in a little bit here, okay, and we go to a daily chart, this is the warning sign that we need to be cautious of, right? So we're going to go over some of the warnings before we go into all of these bullish signals that we've got, suggesting we could be due for a rally sometime very soon. Now, the big question is, will it be a real rally, okay, or potentially just a dead cat bounce? So we're here at the daily chart for our 4 pillars. Okay, and take a look how SMH, semiconductors, and tech still have a large gap down to fill. Both of these have large gaps down to fill. These gaps fill a majority of times in the market. It's just a big question of when. And when you look at XHB and XLI, both of those had gaps down to fill, and both of those broke through that key support level here and came down and filled their gaps. So the big question is, will the pain in the stock market continue? And if so, it's most likely going to be because we're seeing SMH come down to the gap fill around 130 and XLK coming down to the gap fill around 155. So be on the lookout for those. All right. Let's talk about some of these bullish signals, right? We have right here. Okay. So what we're looking at is actually going to be TLT on the top, and then we have the S&P 500 SPX index on the bottom. Okay. And TLT oftentimes can be a leading indicator for the stock market. Now, what do I mean by that? Well, take a look at the divergences that occur, right? So over here, we see TLT continuing to make lower highs, right? Well, meanwhile, the S&P 500 is making higher highs. If TLT is going to be a leading indicator for the market, then the market should be due for a pullback, right? And sure enough, that's what we end up getting. Same thing over here, where TLT is continuing this long run of making lower highs. Meanwhile, the SPX is making higher highs. So if TLT is a leading indicator again, we should be due for a drop in the market, okay? And most recently, we're seeing lower lows here. We're seeing higher lows here. Stock market should be due for a drop. Okay. And sure enough, that's what we're getting, right? And we continue that, right? Over here, we're making lower highs. Over here, we're making higher highs, suggesting the market should get a drop. And sure enough, we do. And now we actually see TLT making higher lows. So if TLT continues to make higher lows while the stock market is making lower lows here, it could be an indicator that the stock market is actually due for a potential bounce to the upside, right? So that's one of the, kind of bullish indicators that we're looking at behind the scenes, right? Diving underneath the hood of the market. We're also seeing that in the tips and NDX. Okay. So you can use TLT for the S&P 500. And oftentimes you can use the tips, Treasury inflation protected securities for the NASDAQ, right? And, we've seen the same thing. It can be a leading indicator, right? We won't spend too much time going over the same things, but what are we seeing? Lower lows, and we're seeing higher lows here. So if this is a potential leading indicator, it could mean that the NASDAQ is due for a little bit of a relief rally and a bounce. Okay. If we dive into the percentage of stocks above their 50-day and 200-day moving average, all right, we'll zoom in here real quick so you guys can see that there's multiple times where this has been, there's been signals based off of this in the market, right? So you can see here where, we're in this downtrend right here, but meanwhile, the percentage of stocks trading above their 200-day moving average and their 50-day moving average are making higher lows here, right? So we're seeing a divergence here, a bullish divergence in this case, right? And sure enough, that's right around when the stock market actually bottoms and goes on this tremendous rally. Okay. We see the same thing over here at the most recent bear market lows. All right. We're seeing lower lows on the S&P 500. Meanwhile, percentage of stocks above their 200-day moving average and their 50-day moving average are making higher lows. And look at what we've got right here. The percentage of stocks above their 50-day moving average is making higher lows while the S&P 500 is making lower lows here. Okay. And we're getting very close to extremely oversold conditions. Typically, when less than 20% of stocks are trading above their 200-day moving average, that's very bearish, right? And that's very oversold. And historically, this has been a good buying opportunity whenever we come down into these instances, right? Take a look here. Okay, and you can see how the market performed afterwards. You can see whenever we come down to these very oversold conditions, those have often been good buying opportunities. So we'll wait to see if this is going to continue going lower or if we could potentially get a divergence. But right now, the big divergence is going to be on the percentage of stocks above their 50-day moving average. All right, and that's also very, very low right now. Only 10% of stocks roughly are trading above their 50-day moving average in the S&P 500. All right. And that's very oversold type conditions. All right. So, those are some of the bullish indicators that we're seeing across the market. When we take a look at the skew and the SPX, we're also seeing something a little bit similar there. Oftentimes these trade in relation with each other directionally, right? So as you see the skew go up, you're going to see the S&P 500 go up. As you see the S&P 500 go down, you see the skew to go down. And, we're at this point here, right, where if we take a look, basically over the past, couple months, little while in the market, we're seeing that, meanwhile, the market's just continuing to make these lower lows, right? Lows, higher lows here on the skew, right? So again, we're seeing a little bit of a divergence there too, while the S&P 500 just continues to keep on dropping. Okay. If we take a look at, some other factors right here, okay, things like if we hop into our defensive, okay, these are the warning signs that the market has been giving you, right? So if you're ever wondering, like, how do I tell if this is actually a real rally or if this is actually a real crash in the market, these are a lot of the metrics that you want to look at, really to pop underneath the hood of the market and truly understand. So before we break this one down, I do want to mention that all of these flexible grids that I'm using here on Thinkorswim, which is a really great platform, okay, these are actually all available in my Discord. Okay, so in the Discord, in the Investment Intelligence Discord, you can click on the flexible grids here, and you can see the 4 pillars, right? The flexible grids are here for you guys to simply click, so you don't have to put in all of the hard work. Let's say you guys actually have lives, okay, and have stuff to do. All of the hard work is done for you guys, and you can just simply click on these scripts. All of the ones that we're going over in this video, as well as many, many more, are in here in the Discord for you guys to use and really just help, bring that knowledge to you guys so you can dive into these metrics of the market on your own without having to rely on someone else. Now, let's get back into the video here, okay? And what we have is high beta stocks versus low volatility stocks right here. So as this goes up, this means that high beta stocks are outperforming low volatility stocks. That's typically bullish, okay? And, as this is going down, you're going to see low volatility stocks outperforming high beta stocks. And typically that correlates with the market here as well. We have consumer discretionaries versus consumer staples here. Okay. So as this goes up, discretionaries are outperforming staples. We've got credit spreads right here. All right. And then we've got biotech. And so basically, to get a good understanding of market confluence, you want to see all 4 of these measures going in the same direction. Okay. Now we've got biotech on here because that's arguably one of the most risk on asset classes. Okay. And so it's another way of just measuring if the market is risk on, right? So this is a way of taking a look, and that's why it's called defensive, to see, is the market defensive or offensive right now? Okay. And we have 3 out of 4 currently right now, okay, are just continuing to go lower, right? You have high beta, low volatility continuing to go lower. Discretionaries versus staples continuing to go lower. The only one we saw a recent uptick in over the last week was actually in credit spreads, okay, and biotech continuing to go lower. So, this is a warning sign. Right. Even though we're spotting some of these potential, bullish signals, when we actually dive into the market and take a look, there's only 1 out of 4 of our, measurements of if the market is defensive or not. Only 1 out of 4 is not even offensive, but trying to, get an uptick here and trying to go a little bit offensive. Okay. For us to see a sustained rally in the market, we're going to need to see all 4 of these start to trend upwards and break out of their recent downtrends. Okay. That's something very important that you guys want to pay attention to. If we take a look at, the Magnificent Seven versus, the S&P 500 without the Magnificent Seven, this thing is actually making new lows, guys. Okay. The stock market minus the Magnificent Seven looks absolutely terrible, right? And even though we've seen, the Magnificent Seven have a pretty sharp decline here, okay, a lot of the pain in the stock market is still being masked by the Magnificent Seven, right? That's what we have on top. And look at the performance, right? Look at the change. Look at how drastically different the performance is in these. And the big warning sign that we want to be cautious of basically is, if we take a look here and just draw a simple trend line, we're approaching that trend line here currently at the moment. All right. And if we break through here, that could potentially lead to more pain for the market, right? I mean, that's not a perfect trend line. That's just a quick drawn, type of trend line so that you guys can understand and visualize real quick. All right. If we keep looking at some more different things, we have high yield versus US Treasuries. This is basically our credit spreads here. All right. And, this is a little bit more of that bullish signal that we were talking about. So we've got the S&P 500 on the top here. We've got our credit spreads on the bottom here. And you can see when there's divergences between these, oftentimes that can be a leading indicator for the stock market as well. When this is making lower lows and the S&P is making higher lows, it suggests that, the S&P 500 is due for a little bit of a pullback, right? And what are we seeing now? Again, we're seeing that slight uptick here while we're still seeing a downtick in the S&P 500. So, while there are certain signs that, hey, the market could be due for a bounce, we don't really have anything under the hood saying that we're extremely bullish, right? Rather, a lot of things underneath the hood are suggesting and reinforcing the theory that things have been pretty bearish over the past couple months and over the past few weeks. And they're going to continue that way until we see a change in, a lot of these metrics, and we start to see them change, right? When we talk about the risk on, risk off ETF, we have risk on up here, which is basically comprised of things like copper, high yield bonds, the Aussie dollar, semiconductors, and high beta stocks. Then you've got risk off here assets, which is going to be gold, US Treasury bonds, the yen, utilities, staples. And then we've got the S&P 500 here. As the risk on indicator and ETF is going up, you're going to see that the S&P 500 is going up, right? And as this has been going down and risk on has been selling off, you're also seeing here that the S&P 500 has been selling off. Meanwhile, the risk off ETF is actually breaking out. So again, a lot of things, kind of just reinforcing the bearish narrative that we've had underneath the hood. And until we see these things change, most likely we're going to stay in this downtrend. And we really need to see all of these different components that we're looking at together really start to break out to the upside. For things to change potentially in the market and for us to switch tones, right? The tone has been very bearish. We're getting some signs that we could be due for a bounce, okay? Some different signals across many different aspects we covered in today's video. And for us to get a sustained rally out of that, let's say we do get a bounce, these are going to be the ways that we can look at the market and measure, well, is this just a dead cat bounce? Is the market going risk on yet, for instance? Is the market out of defensive and has it switched to offensive? How do the four pillars look, right? Do the four pillars look bullish or do the four pillars look bearish? These are some of the things that you really want to use to help give you that edge in the market. And hopefully you guys enjoyed today's video. If you did, smash that like button, subscribe to the channel for more. Don't forget to sign up for the Discord using the link in the description so you guys can get access to all of this, okay? And not only that, but the different trade ideas, market commentary, and all of the valuable resources, and be a part of a trading community. If you enjoyed this video, you're really going to enjoy this next video. This is going to cover the expected move for the market for this week, go over the gamma levels, go over the max pain levels, the call walls, the put walls, all right, and get you guys prepared for the upcoming trading week when it comes to trading the S&P 500 and the SPY ETF.